everyone, and welcome to our session. So, as you probably know, 2023 has been a challenging year for startups. In the first half of the year, the VC deal making dropped by around 60% versus the same period in 2022. While only 2 years ago, we saw $106 billion flowing into European companies, we're expecting about half of that for the current year. This is, of course, on the back of a deteriorating macro environment, but also fewer exit opportunities, with the IPO windows being closed. For those companies who are brave enough to go to the market, you can expect longer processes, tougher benchmarks, and less generous valuations, unfortunately. However, we also see these challenges as an opportunity for the ecosystem to reset and go back to first principles. Software startups are showing resilience and capital efficiency, as well as renewed focus on stronger unit economics, aspects that are reflecting of the scalable and impactful B2B SaaS ecosystem. Today, with our panelists, we're going to talk about the market environment, what it takes to raise a round today, getting some practical advice for the founders out there, and also some alternatives to traditional VC funding. So before we kick off, can I please ask the panelists to introduce yourselves?
Check this is on. Yeah. Good afternoon, everybody. My name's Chloe Allen, and I work at Octopus Ventures. I'm the deal origination manager for the B2B software team. So Octopus, for those of you who don't know us, is one of the most active venture capital investors across Europe. We've been around since 2008, and we back the people, the ideas, and the industries that we believe are really going to change the world. So far, we've invested in over 200 amazing businesses across the 5 core sectors that we invest into. High street names, which aren't B2B software, but ones you may have heard of, include Kazoo, Zoopla, Depop, Big Health. And we've also had over 38 successful exits to date, selling to Google, Microsoft, Snap, Twitter, to name a few. In the B2B software team, which is the area which I focus on, we back businesses from seed right the way through to Series B. I personally focus on Series A and Series B rounds for companies that have got over £1 million of ARR onwards that are based around Europe. So we've got portfolio companies in lots of European countries, but actually I was just saying earlier that we haven't got one in France yet. So maybe there's someone sat in the audience that we may be able to back in the future. But we've got Logify that we've made an investment into in Spain over the last 12 months, and Value Blue, another one which we've made in the Netherlands more recently, both of which you may well have heard of. So lovely to meet you all.
Who will be your first French tech investment? That's a good question, maybe in the room. Hi everybody, I'm Adrian. I'm the founder of Eldorado. Actually, we have our office here, so if you want to take a coffee or meet the team, don't hesitate. We are a digital platform that helps entrepreneurs to raise funds, but also to identify multiple funding opportunities and financing opportunities, which in France and Europe there's plenty of it, with loans, grants, and so on. And we gathered lots of data and insights about the ecosystem, so I hope I will be able here to help on see what will be the next months of our ecosystem and European ecosystem.
Hey, I'm Matt. I am the lucky, I would say, manager of eFounders. eFounders is a startup studio that's been around for more than 10 years. We've built a bit more than 40 companies, and super happy to discuss how the funding environment has evolved in the past couple of months, because definitely some things have changed.
Good afternoon, everyone. My name is Augustine. I'm a general partner at Ovni Capital, deep tech seed fund based in France, and we've made 3 investments to date. So we're entering we're entering with new metrics. It'll be interesting to see what we have to say today.
Perfect. Thank you, everyone. Just a brief word, I'm an investor at Partech. We are a multi-stage VC fund. We've invested across 220 companies in 40 countries. And the B2B SaaS rock stars of the portfolio include the likes of Agricap, Penny Lane, Ecovadis, and Akeneo, you may have heard of. Now, kicking off the discussion, I know, Adrian, you have a lot of data about what's going on in the market. There's a lot out there, but what are you seeing in 2023? What has changed when it comes to fundraising, especially applied to SaaS companies in Europe?
Yes, thanks. This is good for me to be the one who is talking about the dramatic situation. No, just kidding apart. We knew that 2021 has been crazy for all the ecosystem, but now the down runs and the struggles persist in 2023. That's what we can see first. As I need to read some insights, and as it's the Rugby World Cup in France, I need to wear my glasses, so I will wear it. Sorry about that. So, we see that in 2023, the global tech ecosystem has been down by 11% in between Q2 and Q3. Q1 and Q2, sorry, and Q3 we will see, definitely. And year to year, the seed rounds and late stage round has been down between 35% for the seed rounds and 79%. So we were in the habit of having big rounds, big unicorns. Just remember, we have only like 25 unicorns in 2023 right now globally, instead of 221 in 2021. So definitely the climate changed. There's definitely some a new normal economic period that we are living right now and that we are facing. It changed lots of things for entrepreneurs, especially in SaaS. So SaaS is difficult to measure because it covers lots of sectors. But what we can say is regarding the valuation first. They dropped between their highest peak in middle 2021 was about like 16-time revenue for a SaaS per revenue startup. And now it's more about like 6 to 7 times. Maybe the VCs will tell me that it's more or less than that, much more or less. And the founders in the room much more high. But there's definitely a new paradigm in how to evaluate SaaS startups. What about the hot topics? Maybe we can discuss. Maybe there's other panels that are discussing about it. But climate tech startups and deep tech startups are getting highest seed rounds and valuation rounds. So if you are in that sectors, it's good. If you're not, it's not bad as well. But they're the most looked right now sectors in the tech ecosystem. And maybe like to tell that it's not doom and gloom for everybody and for every the market, especially for seed rounds. There's getting more and more money because the VCs now have some difficulties by evaluate Series B startups, especially in SaaS, because of the down rounds, the metrics that have evolved quite differently since 2021 and 2022. So for early stage startups, there's still lots of dry powder, even if some VCs are getting less money right now. So the VC-backed VCs, for example, are having like 8 to 10 billion this year instead of 28 billion last year globally. So it changed also a little bit their way to do business because they need to be more patient and to be more, like, let's say, realistic about the markets and the valuation of the startups. So.
Thank you. That's super interesting. We're actually going to touch upon a few of the topics you mentioned separately, but definitely echoing, it's quite a dramatic drop. I mean, you said minus 70% for the later stage startups. I think that's also a reflection of the fact that a lot of companies that raised in this previous, blooming environment have done a lot of internal rounds. So as a later stage investor, I'm curious to see when those companies will come onto the market after they've maybe had 1 or 2 extensions with their current investors, and we're going to see what's really happened. I'd love to ask you, Mathieu, as you really, at eFounders, you've been creating companies for the last decade. When you think about B2B SaaS companies, what are the topics that you think are interesting? And given the topic of our panel, what is fundable in 2023?
That's a $1 million question, but I'll try to answer. What we see, and a bit based on what you have said, it's a very much polarized investment environment where you still have some of those crazy funding rounds and mostly driven by two things. I would say on one side, it must be very AI driven, or on the other side, having very extremely talented teams with repeat entrepreneurs or very successful VP operators from scale-ups. In those two categories, you can still see, and we can still read it in the news, pretty crazy funding rounds. That looks like 2021. But I would say for the rest of the funding market, and at least in what we specialize in seed stage, I would say it's back to basics. What we've seen during the crazy period where it was mostly FOMO driven, so fear of missing out, deals going very fast. For now, it's back to basics. And what do I mean by this? It's really about demonstrating the value you're bringing to your customers. And so for us, one key things we have evolved at eFounders during this period, we have moved to a design partner approach. To be very concrete, for every startup that we initiate internally, we have a step where we need to convince potential prospect to co-build a solution with us. And becoming a design partner on one of our new startups is actually something the company will pay for, and something where we will commit to build a solution that will solve their needs. So we are super close to our ideal customer profile or potential customers to make sure to get this right, okay? Because now, when you raise a seed round, at least what we believe is that you need to get this right, okay? This is the first part, and you need a clear path to roughly, I don't like to say specific numbers, but basically 1 million ARR, which will bring you to the next step in terms of the funding round. But of course, at seed, something that has been a bit missed in the past couple of years is the quality of the founding team. This is a key part where VC will now take a lot more time to evaluate the quality of the team, see how fast they ship, their velocity, and also their fit on the market they're trying to solve, okay? Because it takes a lot of time to build successful companies, so they want to make sure it's the right team in place. So it's a bit different, yeah.
That's great. And maybe a follow-up question on that last point that you made. I read some stats recently. Of course, there's more and more repeat founders and founders that are ex-operators. How important is that, in your opinion, in a successful, Series A fundraise?
I would say it definitely helps, okay? Especially at the earlier stage of the funding, the more it helps, because at the end of the day, you don't build a successful company because you're a repeat entrepreneur. Okay, so you might have insight, ways of doing things faster, a good network and all this, but at the end of the day, you're building a business. So it definitely still helps a lot at the pre-seed, seed stage, but as the company grows, it becomes less important and the metrics becomes much more important.
So it's that first hurdle, really. And Augustin, would you agree on what is said? You are the one who specialized at seed investing. So what is it that you want to see both in the metrics? We mentioned, there's early metrics in the team, other aspects that you think are important, maybe today more than they were a couple of years ago for you.
Well, there's one thing I would build on what you said. Geographically, I think we're in Europe and the US are in two distinct categories. In terms of what areas are fundable. So to go back to what you said, 2012, I think 2012 there was 16 billion in VC funding annually. 2022 there was 600 billion. So literally every single sector was VC compatible. We're back to a much lower number. Adrien mentioned it earlier. And so now VCs are becoming a lot more demanding with what they're funding. What we see in Europe, and I think that's why we like to call ourselves a deep tech fund, is I think VCs are going back to basics, which is financing disruptive innovation. and not just financing the next digitization of some software, some industry supply. Or what I mean is, like, in Europe nowadays, what I see investors do and what I see investors like, no matter what the sector, there needs to be some sort of proprietary technology at the core of the product. And that in Europe, you'll be able to get funding. And so, you know, we talk sometimes about execution plays. I think it's a lot harder in Europe these days to fund execution plays. The US, I think they've gone back to basics too. But, you know, it's still the biggest market in the world, and you can still get execution plays going. So to answer your question, I think you really have two markets. You have the US and you have Europe. And I'm sorry for people who are not, you know, we're not participating in those markets. I'm not too familiar with Latin America and Asia. But at least in Europe, everything fundable these days has to have some sort of tech aspect to it, to the product. Or, well, I think we just talked about it, or maybe it's a repeat entrepreneur and he's building on his, I think that still works actually. I just saw a deal where it's a repeat entrepreneur and he's, you know, he's raising 5 million at a 20 million pre-money valuation, and there's nothing. It's pre-money, pre-product, and there's not much tech to it. So it's an execution play. So that's Europe. I think the US, I mean, the US remains the US. I think you still have crazy rounds on very niche products, and so that's the way we view the market. And how do we play as a VC? So I said, you know, we focus on France-based startups. Honestly, a great way to create value is to try to push our companies to sell their products day one to the US, in the US. I think I mean, it's a different subject, but when we talk about successful funding strategies, if you're a Europe-based company, one of your successful funding strategies depend on your market, but, you know, sell your product in the US, become VC compatible for US VCs, and all of a sudden you have your potential fundraisers was quadrupled in size. That's it.
Absolutely, absolutely. We have seen a significant drop in US funds investing in Europe recently, but it's still happening, so I fully agree, especially with the software market.
You're right. What I'm saying is, move to the US.
Move to the US, okay.
Avoid that. Become a US company with the, you know, science research in Europe.
Absolutely, when the time is right. Which takes me actually to Chloe. So you come in at the later stage. Your focus is Series A and B. What is your take on what it takes today to raise a successful funding round at your stage for B2B SaaS?
So I'm looking at this through the lens of a Series A and Series B company, which is the areas in which our team focus on. And for us, we probably maybe were a bit more reserved during 2021, 2022 in terms of focusing quite heavily on the capital efficiency of a business. But you will have seen over the last 12, 18 months, actually, a lot of funds at our stage have gone in that direction as well. And rather than focusing on growth at all costs, actually focusing on some of the core metrics that really help a business be more efficient. So you'll hear people talking about burn multiples as if they're, you know, a new ratio. I mean, 12, 18 months ago, for example, we were looking for businesses that were growing at least 150% year on year. Whereas now, actually, if a company's growing 80, 90% year on year, but growing in a really efficient way, that's become very attractive to us as well. Core metrics that we're spending a lot of time focusing on at that point include magic numbers, CAC ratios, and burn multiples. So if I was to use burn multiples and as an example to bring that to real life, if we think 12, 18 months ago, a good burn multiple, which is how much money you're burning versus the amount of ARR that you're adding, a ratio of 3 was really good. Whereas now, for Series A and Series B, if you've got a burn multiple of around 3, then you're probably going to really struggle to raise. So I think that's kind of what we're seeing a lot more of at our stage at the moment.
Okay, thank you. And thank you also for bringing some concrete examples. I think it's really useful for the founders and the audience. Another topic I wanted to touch upon, and I think we cannot have a panel in 2023 without mentioning generative AI. What do you think about companies that include generative AI into the roadmap, so not Gen AI native companies, Is that a good strategy for fundraising? Should founders do it? Yes, no? What are your thoughts on this? Open to anyone.
I'll start. What we see, at least on the seed side, is that raising fund today without an AI strategy, I would say, is mission impossible. So it's not even a question, but it's more how defensible is your AI strategy. And as you rightly said, I'm not speaking about AI first company. I think it's key. And as Augustin said, there is a feeling that not having AI, let me put it this way, is that you'll build an incremental SaaS. You will capture a bit more value because you digitalize a bit more, you improve a bit more something already there. And that's not what VCs are looking for. You know, what they look is for radical innovation when you really can capture a market. So for us, this is a key part of all the companies we're launching, is having a clear, defined, defensible AI strategy in each product. Yeah.
So it is AI or die for you?
A bit, yeah.
Other thoughts on this?
So we've probably got a bit of a different view. We've got a bit different view to that, in that, as we all know, AI has been around a long time. It's just become a pretty hot topic over the last 12, 18 months or what have you. And from our point of view, our experience to date has been very much investing in software businesses that automate or digitalize manual processes to make those processes more efficient. And at the same time, AI, to some extent, depending on how it's used, is actually removing the requirement to have any human intervention whatsoever in certain processes. But as a team, when we're assessing businesses and determining whether or not we take those forward to our investment committee, we'd want to see that founders have considered and thought about how AI may fit into the roadmap. But for us, the biggest question is, have you considered it? If so, what problem is it going to solve? And if it does solve a problem, are customers willing to pay for that? Because we don't just want to see Gen AI in a roadmap for the sake of it. We actually want to see that it's in there for a specific reason. So, yeah, we're a bit more open-minded around it. I guess with portfolio companies, though, and making new investments, it's something we talk a lot about in the investment committee. Because from one hand, it can be a huge opportunity for businesses to use AI in a way that can make that business more defensible. One of the companies in the Octopus group, actually, for those of you who've heard of it, called Octopus Energy, is a thriving business. And they've recently implemented AI into their customer services part because it's making them respond to customers quicker. The accuracy of those email replies has been significantly higher, and actually it's been able to make that business more efficient, which is super. But on the flip side of that, if you've got a company that you're considering investing into, and Gen AI, as an example, could remove the requirement for human intervention, that isn't where we sit as an investor, and that would be something that we would see as a threat rather than an opportunity.
Very interesting, thank you. Unless others want to comment?
A little one, I will join another team like No AI, Don't Cry. Because even if you don't have, as it's the hot topics, everybody is talking about having engineers, AI team, tech team that are really at the top of the knowledge of Gen AI. And it's quite difficult. There's really a small amount of founders that are really having a high knowledge of this these opportunities and what is happening. But definitely you need to position yourself in the middle of it, even if you don't have an AI first strategy. As you say, Chloe, you need to bear in mind that there's others that can have some kind of an AI in your market or direct competitors. So you need to think about how I can be more automatic driven or competitive regarding using an AI software in my business. As we said before, we are covering lots of sectors regarding SaaS models, so you can not having being really AI first company, but definitely you need to bear in mind that you need to see what the market is evolving regarding this. Not only because of the VC fund strategy, but also because your clients will need some more quick and automation.
Absolutely. And we've talked a bit about what VCs want to see, but, you know, Adrian, I know that you, for instance, are an expert also in what are alternative fundraising strategies. So what else is out there for the founders here who do not want to go at this point for a VC fundraising?
Yeah, so there's a new hot words that came through these 2 last years. It's clients. So this is the first one. So profitability. I heard about this. I'm hearing lots of new buzzwords like bridge rounds a lot, or extension, Series A extension or something.
Absolutely.
So this all VCs, your investors, and private money could be a solution, but it's really hard. You need to expect a slower timeline, so you need to bear in mind that there's lots of other financing opportunities, so your clients can be more with a cost-cutting strategy and a more pragmatic and focused strategy on one sectors or one client or one vertical or so on. But on the other hand, we have the chance in France, in Europe, we are living in a world that there's a public bank. So in France, we have BPI, which is a French Bank Public of Investment, that helps entrepreneurs that have their headquarters in France or activities abroad, but they doing some value in France to have some grants, loans, and other tax advantages. European Union is helping a lot of entrepreneurs regarding 3 major sectors, so which is industry, climate tech, and deep tech. So there's plenty of non-dilutive funding opportunities that you can have in this period of time. Private banks are not the best friends of startups, but since 2020 and the explosion of the French tech and the European tech market, they have all specialized by having innovative team helping startups, because they know that at the end of the game they can also have big clients and big tech companies in their portfolio, so they are eager more than before to help entrepreneurs. And also you can spend some time to read some, let's say, alternative funding option, such as crowdfunding, crowd equity, revenue-based financing, which is a really good opportunity for SaaS B2B startups. With your monthly revenue, you can see that there's some leading in Europe, from the French tech as well, such as Silver or Carmen, which are French startups that are going really fast by financing other startups that are in the need. So I think that's already something, but it helps you to gain some more months, more resilience about with your business plan, and also your ability to drive through another market from 2 years to the next one. So be open-minded and try to see if there's other non-dilutive financing than open your capital again.
If I may add just
Of course.
something on top, I fully agree with everything you said. I would just add one more that we have seen from the past 10 years take on more and more space in all our funding rounds, quite the seed size, is the business angels. And I think with the ecosystem being quite growing and maturing, especially here in Europe, compared to before, at least for us, it has become a significant part of our funding strategy for startups, or something we consider. And when I look back at the last 4 or 5 companies we raised fund for, coming from e-founders, the stake in the round from business angel has been growing. We even had 1 or 2 that raised only from business angel, and not to do some promotion here, but we have built a company called Roundtable that actually helps companies raise fund via business angel, and makes all the process much more easier. But we truly believe this is a good alternative and could be an intermediary step before going to the VCs.
Absolutely.
If I want to go, if I can go one step further, I think you guys mentioned all these bridge round extension. It's typically a result of 1 or 2 things. One, lack of client, lack of revenue, and or lack of disruptive technology. Lack of technology. VCs deem that you have a lack of technology disruption. And so it's interesting. Entrepreneurs a lot of times think, VCs are only source of dilutive financing. And there's so much more than just VCs, non-dilutive, and business angels. I think I've invested in startups and they have trouble refinancing. And I say, look, have you looked at corporate VCs? A lot of time, entrepreneurs are so trained to think VCs are the only way to go. They don't even think of like what the market deems, tier 2, tier 3, tier 4 VCs. I don't think they're tier 2, tier 3, tier 4. I just think they have different return expectation, but they're just as good investors. You might not have the same valuation, but they're still, still financing. In France, and I think in Europe, there's regional funds, corporate funds, clubs of business angels. There's tons of funds beyond VCs. And I think one thing I see in France is I see a lot of funds, a lot of entrepreneurs restricting themselves to the French funds. And, especially in a situation where it might be tough and those, bridge and extension, you gotta look outside, especially if you have a bit of revenue outside of your own country. So I guess my only takeaway from this is VCs are not always right. You know that. We have a 10% hit rate, success rate. And there's tons of great financiers out there that don't have the same results as us, that don't have the same expectations as us, and have a lot of money and want to deploy that money. I actually believe that a lot of future unicorns, billion-dollar company we're going to see within the next 5 to 7 years are going to be financed by these tier 2, tier 3 VC funds that I mentioned, just because, funds were so scared last year that we gave a lot of space to non-traditional financiers. So that's my little addition to what you just said.
And do you feel that today there is still a mismatch in what are valuations expectations between the VCs and the founders? Or do you feel we've all aligned to the new normal?
At least at the seed level, valuations haven't changed so much. They haven't gone down to 2017 levels. So I don't know if it's Series A, Series B. What do you think?
I think we're on a journey. So we're getting there, but I think there's still, when term sheets go out and things like that, there's probably a lot more negotiation around that than there was 12, 18 months ago. But I think we're coming to a bit more of a common place, but I think there's still a way to go yet.
Yeah, I think Series B growth is probably where there's the most friction, no?
A bit of a friction. And maybe building on to that, are you seeing any other commercial terms that are particularly aggressive? I think we've seen a little bit of that happening last year. Do you think it's still going on? Especially at
On the extension and bridge, I see very aggressive terms. I'll see like 3x preferred, taking into account the previous round. I technically advise not to do this. It's easy to say, when the founder doesn't have money. Well, the founders don't have money, but I try to say there's always a way to kind of get out of this. But yeah, that's the most aggressive I've seen. At least if you want to, you got to negotiate not to include the previous round, or you got to go 2x or max 2x.
And of course, we've talked about sort of, going back to fundamentals, being a bit stricter on metrics. Is there anything beyond the metrics that you need to see in the fundamentals of the company, in a pitch deck or in an equity story, or that you want your founders to have before going out to the market and raising that next round?
So for Series A and Series B, so this is 1 million of ARR and beyond, we'd need to see that a company has product market fit already. So we want to see some evidence, and when we're chatting to you, there's the types of conversations we'll have in terms of, what is your ideal customer, what problems are you solving for them, and why are they buying the product? That's really important to us. And so some of the other indicators that help us understand whether you've got the product market fit there as well include things like your gross margins. So ideally we'd like to see those from 80% onwards. to see that customers are actually calling you because they're interested in the software that you have, rather than every single time it having to be kind of you generating those leads. And ideally to have had some customers that have gone through that renewal process, and that then gives us a good indicator that you've got a good handle on your metrics as well. At Series A and Series B, we're not necessarily wanting you to have the go-to-market fit, but we'd like to see that you've got that wheel in motion. So understanding, for example, for those ideal customers, what are the best ways in which, or the best channels for you to be able to reach out and get in front of those customers, and which of those channels are more profitable. We've definitely seen over the last 12, 24 months, if we talk about 21, 22, for example, people doing a big Series A or Series B round, using that money to throw at the go-to-market strategy, hiring loads of people, and actually the fundamental part of having that repeatable sales process wasn't actually there. And so for us, if you were to take funding from the likes of Octopus, we ensure post-investment that those fundamentals were in place before we then go and hire and extend the sales and marketing team. So a good example of that, actually, a company we backed called the Safeguarding Company. They have software that protect vulnerable adults and children, and they had a fantastic product. Lots of schools and police officers and things like that really, really wanted the software. They were getting lots of incoming inquiries through that. And when we invested in them, we saw, you've got a really low average contract value here, and yet your sales process is actually sending somebody to do a demo at each of those schools every time you want to close a deal. So fixing those problems first before you go and make huge decisions on hiring lots of sales and marketing people is something that we work really closely with founders on at that stage.
Thank you, super useful. That said, I did listen to a podcast recently where an investor was arguing exceptional founders need exceptions. Would you agree that, in some cases you will slash everything you just said to make an investment in an exceptional founder or company, maybe to the others on the panel as well?
I mean, with any investment, it's not, there's no rule book to tell you this is exactly how you do it. And, we've got a talent team within Octopus that work exactly with founders to help them make those decisions as well. But definitely, we've got a lot of experience in supporting businesses through that growth journey, and we're there not just to give you money, but also as a partner to help you grow. So there is, a common conversation that goes on. It's not, one size fits all at all, but general guidance is that.
Great, and as I think we're almost out of time, I have one last question for each of you. For the founders in the audience, what is one piece of advice that you would give for founders going out to the market to fundraise, and what is one mistake to avoid?
My advice, actually, you just talked about it, which is you can raise your seed round by pleasing your investors. If you're going to raise a Series A, you got to please your customers. You've heard this, but it's so nowadays it's paramount. Small advice, I think.
Something I already mentioned, but I would say an advice would be back to basics. I'll encourage everyone to focus on having 10 customers that really loves your product instead of having 100 that can basically live without it. And on the mistake that we sometimes see, or we try our founders not to make, is to really sell and communicate why this team is the right team to grasp the opportunity, and why now, and again, why this is the right opportunity to fund at the moment, why this is not an incremental business being built, why this is a radical shift that is being captured.
Following on from some of the things I've said, probably one of my advice, and we've talked about it when negotiating term sheets and those types of things, is when you're thinking or considering taking money from a VC, this isn't just taking money, it's also partnering with them. And so I think my advice would be, when you've got a few term sheets on the table, is not only looking at the valuation or the terms and those types of things, but I would really give you all a piece of advice, which is look at the portfolio companies, proactively reach out to the founders and ask them what it's truly like to work with those investors, because I think that's probably the most honest review that you're going to get from an investor. And mistake-wise, so as I run the deal origination team at Octopus, I tend to do all of the first meetings that we have with businesses. And if you're cold approaching an investor, I love receiving cold requests, and we all do. But keep those emails short and sweet. Match those emails to what the mandate of that investor is. So for example, if you're a Series A or Series B company based in Europe with over 1 million of ARR, I'm probably going to meet you. So just say that in the first sentence. It saves you loads of time having to write a really long email, and it saves me loads of time having to read through a load of stuff to go back to you. So that would be another piece of advice.
On my side, I will say, like, go to tech events to find some clients, so everybody out. No kidding, but just be focused, as Mathieu said, not only with the sales, but also focused with your business plan, focus on your strategy as well. If you want to raise fund, you need to expect slower timeline, as we said. So be focused on what every euro or every minute should be profitable for your startups and your revenue and your growth. And the mistake would be not being realistic and transparent with yourself. First, you need to face your own situation and not to lie about it. And with your customers and with your team, that's what we are seeing a lot nowadays. Like, it's really hard for funders, but if you are transparent with your VCs, yourself and your team, it's getting better, I would say.
Perfect. Thank you so much for that. I think we're perfectly on time. So thank you.